Good evening, everybody. It's hard to believe that a year has gone by since we were last here, so it's good to see you all again. I thought that it might be useful this time out to consider business model strategy in terms of both sustainability and prosperity for credit unions, both today and into the future, from a couple of different perspectives. So I'm going to address this subject with just the rider that there are three words there. The first two, business model, mean different things to different people. And probably there's a need for a shared understanding of what it is we mean when we talk about business model. I think everybody here is, you're not strangers to strategy. But business model strategy would appear to us to be probably the most important area of strategic orientation for credit unions today. So I'm going to cover off in a number of different areas. The first is the importance of business model strategy, a comment on business model sustainability, which Elaine has just spoken of. And then I'm going to propose a useful business model framework to everybody, a framework that we've started to use here ourselves and one that we find is ideally suited to credit unions. And it is a framework that has been adopted as well now by the CEO steering group as a way to understand and appreciate the challenges that credit unions are faced in terms of developing and transforming the business model, but also to be able to describe and define what those strategies might be, what these transformation and development strategies may be. So that gets me then to the components of business model strategy at a reasonably high level as a takeaway for everybody. I'm going to comment on the emergence of collaborative structures such as shared services and the need for commercial collaboration, which is something, again, that the registry has been commenting on in many of our speeches, particularly over the last year. And then finally, a few words on the CEO Forum initiative. What is business model strategy? Well, from a perspective, and there are many different perspectives on business model, but one that seems to resonate is how firms grow their business by responding to their customers' needs and their expectations. So it's fundamentally focused on the customer. What are the customer's needs? What are those expectations? How are they changing? What are the products and services that are going to be delivered? How will they be delivered? What channels, etc., are going to be used while that's been done? How much revenue does this generate? And then how much does it cost? And it's quite clear that when you're involved in strategy, for example, for as long as I am, and I won't tell you how long I've been involved in it, but I've been involved in it for a long time, there are many different models that you can adopt, you can look at. And many of you will be familiar with this. Many of these come from the strategic schools of thinking and management schools and that. And you will have come across Pestel and Five Forces analysis and McKinsey 7S and the ANSOB framework and other frameworks that are used principally by very large firms. And they're not really designed for use by small firms such as credit unions, because what they don't recognize, and they seem to miss this as a gap the whole time, is that fundamentally for a small business, its business model is its strategy. What it's doing every day, how it's responding to its customers' needs and expectations, how it's building that flexibility to respond to where they think these expectations are moving to. It's all the stuff of business model. So for a small firm, there isn't a big difference between business model and strategy. They're almost one and the same, which is why I've termed this business model strategy. If we were to look at business model sustainability, again, that resonates with the whole business model concept. We can define sustainability as the ability to respond to external change drivers, whatever they may be, and unforeseen risk events. So this is all about being able to respond to changes that are taking place in the marketplace, changing consumer expectations, etc. But unforeseen risk events as well, having that resilience built into the balance sheet, into the financial strength of the firm so that it can actually respond to unforeseen risk events, while continuing to provide value products and services to members today and into the future. And that members means current members, but also new members as well. And it's fair to say that there are three fundamental sustainability challenges facing credit unions, particularly from a business model perspective and business model strategy perspective: how to improve revenues by growing loans and non-interest income, addressing operational effectiveness and efficiency, realizing those economies of scale and scope that have eluded the movement in the sector for so long. There's a growing emphasis and focus on that. looking at the cost to serve. How can it be made more convenient? How can we improve the access that people want to have with us? Are key questions that many firms are asking, particularly banks and other financial service firms who are spending an awful lot of money and trying to improve the whole convenience and access part of their business. How do you enhance capabilities to deliver on members' needs and expectations? So members have needs and expectations that are created by and through their own use of technology. And you'll have known for the last couple of years, I didn't bring it with me today. I normally take out the mobile phone and put it up like that and say, look, this is the platform of the future. In a more recent report that was done by, I think it's Deloitte, they centered the mobile phone at the center of this network, and the branch was just one part, but right in the center of their vision, if you like, of where financial service firms are going, particularly banks and credit unions elsewhere, is that mobile platform is taking on a dominance now and an importance in being able to deliver products and services using it. So if we take it on to and using business model sustainability as the kind of a hook for this one, there is a need for a shared understanding, as I said earlier, on business model and what that means. So there's a need for a concept, and we should share this as a concept amongst each other so we can describe and define what we mean by that. So there's a need that reflects credit unions' member-focused mission and values. It has to make sense to credit unions, that everybody can intuitively understand the concept or the abstract and the model and what it means and how to use it. It facilitates description and discussion, and indeed at times dialogue as well, and facilitates, critically for me and from my perspective and the bank's perspective, is that it can facilitate strategic thinking at board and senior management level in credit unions about their business model strategy and about what they're trying to do with the business model over the next 5 years and what changes have to be made and what transformation means. And they've got the shared understanding or this common language between credit unions, because commercial collaboration is of growing importance between credit unions and their trade associations and other stakeholders, that everybody's sharing a common language here and understanding of what's been done. And finally, it's a concept or an abstract that would help define business model development strategy and to focus that on what needs to be delivered. So the logic of it is straightforward. The working definition is the logic of how the business works, which is the business model. Working definition could well be how value is created and delivered to members and captured by the credit union. So there are 9 component parts to it. And if we're to look at those 9 component parts and look at a particular model that has been developed in the last 10 years, it's called the business model canvas. This model is used worldwide, internationally, by hundreds of thousands of firms and planners. It's used by NGOs, it's used by credit unions, it's used by for-profit companies, and it has become quite a recognized way of describing and defining what a business model looks like. And there are 9 component parts to it. Customers, as I said earlier, who's been served, what are their needs and expectations, what demands do they have, what do they expect, how do they expect to be serviced. That's the focus of the business model. There's relationships that those customers will have with firms. Those relationships can be over the telephone, they can be over in the branch, wherever. These are different channels that are used then to deliver the products and services, and then you've got the propositions. What are those? They're not just simply products and services bundled. Very often propositions are what people might call the brand, or what people might call, well, what values does this firm represent? And in terms of credit unions, what's the ethos and the philosophy, and what's the proposition that has actually been made to members is more compelling itself than the products and services may on their own be, because those products and services tend to be very generic. The red part is all about the operational model. What are the activities that are being engaged in? What are the resources that are being used? So the activities in terms of a firm will be what it is we're making, and then what resources are we using to make these, and what partners are we relying on to supply us with the services we may need to make all this happen. This costs money. So the difference obviously between revenues and costs, and the bottom line is the profit, or if you like, it's the revenue model, as some people might call it. If you want to know more about this, there's a site, it's sourced there, Strategizer. It's at the bottom of the model. You can click on that and they've got a fairly interesting description or definition of how it works. We believe that this model reflects the inherent customer centricity of the credit union culture, its values and business models. And those business models are focused on delivering value to members today, but also creating value for the credit union itself. So it's a model that we are increasingly using, and if we use it to map the credit union business model today, it looks something like this. I'm not going to go through all of it, but you can see that the different parts of it are there. What are the relationships with members, branch, face-to-face, telephone, post, online, self-service machines for some credit unions? What are the channels being used? What's the product set look like? What are the key activities and the key resources and the key partners out the left-hand side? What's the cost structure and the revenue streams? It's clear when you start mapping and using one of these tools that what immediately becomes transparent is that there is one business model. It's savings and loans. But there are different operational variations of that, and there are different product mixes. But fundamentally, it's the same model, and it has been more or less the same model since the 1950s. It has changed somewhat, and as technology has been applied, and it is exposed today to quite significant challenges, particularly challenges thrown up by digitization and the increasing use of technologies. But if we're to use this model, and on its own, it's customer facing, but to use it correctly, we kind of have to put in two more elements to it. And that's what we've done. We've adapted the model by reflecting on what's the demographic here of the common bond. We've put the common bond, in other words, into the model and said, well, a common bond is made up of people, and those people have needs. There are certain demands that they'll have for financial service products at any particular time. They have expectations of their providers. They expect service to be delivered in certain ways. Increasingly, that expectation is all about convenience and access. And they have certain behaviors that they engage in when they want to relate, and those can expand to using mobile phones and stuff. With competition, of course, you've got competition from existing providers, but also external providers as well, and then the economic conditions which are impacting local and national. Local could mean, well, some common bonds have growing populations, others don't. Some industrial bonds have growing employee bases, others don't. So the common bond, if you like, is where the products and services are made available. And then, importantly for us and for everybody, we need to reflect on financial performance and the strategic balance sheet as well. When we put it all together, the business model begins to look like this. It's got an element focused on the common bonds, but it's underpinned by both financial performance and the strength and the resilience of the balance sheet. If you were to take the model and you were to apply an example to say, well, what if we were to make house purchase loans available here? You quickly discover by using this that all of the elements of the business model are impacted. It impacts everything, from who are we going to make the house purchase loans available to? What product set will we have? There'll be pricing decisions in there. How are we going to make it easy for people to find us? How are we going to provide advice to them when they do? How are we going to fulfill that? And then how are we going to deal with the trouble cases afterwards? So almost all aspect of the business model is impacted the minute you think about putting in a new business line. And that's the power of it, because what it does is it helps you think through the different component parts that need to be supported to transform or to grow or to put in some new business proposition into it. When we put it all together in terms of business model strategy, it's not simply about the business model itself. The strategy has three delivery elements to it. The first is in green, which is marketing, products and services, channels, propositions. What are those? The second one is the operational side of things, the operational model. What changes need to be made to that to deliver on the products and services. And then, of course, there's the financial aspect of strategy as well. So three major areas of focus. They all have to really integrate. And anybody who's been involved in planning over the last years and implementing will know that you really need to have very defined, measurable outcomes in place. Those outcomes can be quantifiable or qualitative, but nonetheless they have to be there, or else you don't know how you're getting on. Critically for us, because credit unions are in the business of incurring risk for a reward, then any business model development strategy has to be framed within and must align with the risk appetite of the credit union. What's your appetite for taking on risk? If it's misaligned, you could find that that your business model is simply not delivering on what it is you intended it to deliver because your risk appetite is much bigger than the model, or it might actually be more conservative than the model itself. What's the capacity to take on risk? What are the staffing capabilities and the abilities? What are the systems that are needed to be put in place to take on the additional risk? And then finally, what's the capability? How do we manage this? So that's the business model and business model strategy. This is a quick slide on balance sheet transformation and a risk profile, just reiterating that if you're to move the balance sheet from one type of a balance sheet that's very heavily unlent, if you like, the loan levels are very low. If you move to a balance sheet where the level of lending increases substantially, well, that's going to impact on different elements of the balance sheet itself. And that brings in considerations around what are the risk and income characteristics of loans, what type of provisioning needs to be put in place. Does the funding actually mix with this because it's all on demand? Do we need to change that? What's the liquidity profile, and other issues need to be dealt with and put in place as well. Finally, a word on shared services. There's an emerging emphasis on commercial collaboration, as it should be. Internationally, we're all aware that the peer sectors in Australia and the United States and Canada and elsewhere have managed to transform their business models and develop them over the years through commercial arrangements, intra-credit union commercial arrangements, which have typically been led by chief executive and trade associations. That they've created the shared commercial enterprises that have brought a number of significant benefits. Those benefits are in the area of competitive operational efficiencies, looking at scale and scope and trying to arrange for that and increase that or to realize it. Improving products and services, bringing new products and services to market, enhancing risk management capabilities where perhaps if you're going into a new business area, small firms find it very difficult to employ the level of technical expertise that's required because of the cost, and they tend to share that amongst themselves. Access to best-in-class expertise, not only in risk management, but best-in-class expertise when it comes to operational efficiencies, when it comes to the digitalization of delivery channels. Realizing these benefits for a credit union requires a number of things. It requires, one, that the credit union has a clear strategy in place, that it's not just simply following the herd and joining up for a shared service initiative or a joint venture alliance, that it has a very clear strategy, that it's part of its business model strategy to do this, and that it has a compelling business case. And that compelling business case looks at all aspects of the business model, not only the expected benefits, but what it will cost and what the risks associated with that may be. So there has to be a very clear assessment of the costs and the benefits and the risks, a very clear articulation of, well, what is it we're doing? What are the deliverables here? What value is going to be created? What are the expected outcomes? And then finally, as everybody will know, intra-credit union collaboration is frequently a long-term commitment. It's not something to enter into lightly. It's not something to reverse out of lightly. It takes investment, it takes resourcing, and it takes commitment. So it's important from our perspective that any collaborative effort enables coherent business model development, that's its focus in this particular area. Finally, just a word on our approach. We are using this model and will be using it. Our supervisory approach will be to use the business model framework as a risk assessment framework. So most credit unions, particularly the larger ones, can expect robust inquiry and challenge around the different elements of their business model. And that's the approach we will take. We will shortly be publishing guidance on business model strategy, which will set out our perspective and our point of view and describe in a bit more detail what I'm talking about today. And finally, a couple of words on the Credit Union Business Model CEO Forum, the Business Model Development Forum. As you know, we initiated that earlier this year. We had its first meeting in June, which was a plenary session at which over 70 close to 70 CEOs attended. A steering group of 15 chief executives has been formed. Both the forum and the steering group are chaired by Professor Donal McKillop. Many of you will know Donal. And the steering group's first piece of work was to initiate a survey of credit union chief executives last week. So that survey I believe, is with every credit union CEO at the moment. And the steering group has asked me to reflect on that and to say to people, if you can get it in as soon as you can, it would be more than helpful because it's going to inform the work of the steering group, and it also helps them to understand what work groups they themselves need to establish and pursue. For our part, the Business Model Development Unit, we will be providing regulatory input to the steering group when they need it, because obviously they may be considering issues that may require regulatory approval or regulatory change or whatever. We'll be providing that input, but we'll also be providing some secretarial, or if you like, assistance support as well. So for example, we've using our own email system and capacity here to send out the CEO surveys, and then we're using our own resources to take them back in again, to anonymize them, and then to publish or make those results available to the steering group. So that's it. I'd like to thank you for listening to me. I hope I haven't run too much over time. I was looking at business model strategy, bringing both business model and strategy together, and suggesting that business model strategy is the fundamental strategy that should be focused on, and it is, if you like, 95% of the strategic plan for credit unions today. Thank you.